Good afternoon, everyone. This is Mark from RightLineTrading, and today what I wanted to do is go over one of our, or probably our most successful trade configurations, and it's called the transition zone trade, and it's primarily what I'm going to be focusing on during this webinar. And I appreciate everybody who's turned out, because I know it's a busy day, and everybody's everyone's tired. So listen, let me just tell you a little bit about myself. I'm a graduate of the University of Pennsylvania, and a former professor at Jefferson University in Philadelphia. And I've been involved in the financial markets for over 20 years, and I began trading in the futures and forex markets about 10 years ago. And what I found when I began trading about 10 years ago was this. What I noticed was that what we have is essentially an industry that in and of itself doesn't function. It's a dysfunctional industry. And I'm going to tell you why that's so. If you look and see what's going on, the figure of 95%, that 95% of day traders, whether it's forex markets, whether it's the stocks, whether it's futures, but 95% of day traders fail and wind up losing their entire account. Now, why should this be true? If each generation of day trader learned from the prior generation of day trader, understood their mistakes, understood the problems with the software they used, understood the trading methodology failures, and built upon those mistakes, then that number would slowly drop over time, and the number of successful day traders would begin to rise. Now, we, as small commercial traders, are trading against the large institutional firms to which we cannot beat. Our goal is to trade with them, and one of the features of the transition zone trade is we leverage the inflow of institutional money. So you have to ask yourself, what is wrong when 95% of day traders repeatedly bust out of the market? And we're going to go more into that because I think that's a key feature of trading that you have to ask yourself. And you have to also ask yourself, if you're trying to be a successful commercial day trader, a guy who or a lady who wants to make a living day trading, you have to ask yourself, what are you doing differently than the last generation of day trader to ensure that your system is effective, knowing that their system did not work? So the reason that this became really important to me was because in my undergraduate and graduate education, I was involved in the optimization of software systems, or mathematical modeling. And really, mathematical modeling is nothing more or nothing less than taking any closed system and determining what are the important independent variables that go into the multivariable equation that ultimately makes a prediction for the outcome that you're trying to achieve. And to say that a little more easily, it's to do this. What I did in graduate school was mathematically model underwater decompression schedules. Now, back in the day when I was training, there were only a few computers in the world, and they ran on punch card operating systems. And so doing anything via mathematical modeling was really groundbreaking. And was really pioneering work. And what the Navy had was a problem doing underwater decompression schedules. Deep dives are very, very difficult. It takes a long time for the divers to get down, but it takes a much longer time for the divers to come up. If you go down hundreds and hundreds of feet, the decompression that's required as you come up is extremely difficult and extremely dangerous. The inert gas, there's 3 gases that you have to breathe: oxygen, nitrogen, and then a third inert gas. That inert gas and the time it takes to move up, and there's stations that you have to stop at, has to be mathematically modeled to optimize, to give the smallest chance of getting the bends, which is decompression sickness, and yet get you up as fast as possible. So the independent multivariable equation has to contain all the physiological parameters that take place in the human body that are important independent variables in determining what's the best way to get up from diving 1,000 feet down in the ocean. And we did that very laboriously using mathematical modeling, and it was really groundbreaking work. The program was called ASOP, which was the Automated Engineering and Scientific Optimization Program, which was written by the Navy. So when I began looking in the futures and Forex markets, I looked at them as no different than anything that I had done in the past. Trading and the movement of the market is nothing more than a closed system. And that closed system is determined, or the direction of that closed system is determined by a series of independent variables. If we determine what those important independent variables are, we can optimize them and come up with an equation for predicting future price movement. And that's exactly what we did at RightLineTrading. And in so doing, we really sort of pretty much threw away all the dogma that almost all of the other software systems use, and really almost the entire trading methodology of the past. Now, the transition zone trade really leverages something I'm going to show you. That's the most profitable single trade configuration we have, based on 2 years of forward testing. Greater than 85% of the trading entries are winners. And what's amazing about it is the superlative risk to reward. For every dollar you risk, on average, you're going to make 3. And a lot of software tells you that they know when institutional money is being inserted into the market. They understand money flow. But if you understand on a conventional chart, there's only 5 things that any chart in the universe, 5 parameters, and that is the high, the low, the open and close of every formation, whether you use candles or whether you use open, high, low, close bars, or whether you use Renko. Only those 4 parameters. There's nothing more. And the 5th parameter is volume. Those 5 parameters are the only 5 that exist. And now you can plug them into different equations and derive different lines, but nothing more is available. So determining when institutional money is coming into the markets is extremely difficult to do, although everyone says they can do it. I'm going to show you how it's done, and you're going to see the rationale behind it. None of this is a closed black box system. You're going to see exactly what I'm talking about. Now, 2 contracts can easily make you $500. Now, what I did eliminate, because I really want to get to the charts. I want to show you a live chart and not just show you JPEGs, because that's what most webinars consist of, and a stylized JPEG can really show you anything it wants to show you. Now, here's the one thing that you have to understand and you have to take as true, not because I'm telling you, but because we forward tested this and we've really come up with an analysis that bears this to be true. day trading has never been treated like a science. It's always been treated like an art. You know, people put together software packages based on trading principles and methodologies that have never been tested mathematically and proven to be true. I mean, if you do a Nexus Lexus world search, looking at the positive predictive value of an oscillator or a MACD or Fibonacci, and look for a published article on that subject, you'll not find it. Now, if any other industry or any other science worked in this way, we would all die because none of the medicines we took would work in disease, because none of them would be scientifically proven to work. And if an architect, for instance, based the way he constructed a building on a set of parameters that hadn't been mathematically tested to support, so that the building supported its own weight, so that we know that when he gives his set of drawings over to the contractor, this 50-story structure is going to go up, and it's going to remain up for 100 years or till something comes and knocks it over. Bottom line is, every other science, and day trading is a science, is based on proven principles, either via mathematically in almost all cases, or in the case of medicine, in multiple, double-blind placebo-controlled trials, ultimately relying on the math to show you that the outcome is not based on some random chance event, that if you get better, it just didn't happen by accident. It happened because the medicine affected a cure. But that's not how we day trade. We day trade because somebody told us an oscillator worked, because the person before him told us an oscillator worked, and so it goes from generation of day trader to generation of day trader, that all of these indicators are effective, but no one's ever proven it. And the guy who invented the oscillator, of whom I have no idea who that is, decided that that was going to predict future price movement. Now, the one thing I can tell you, and you're going to have to accept from me as being true, is I'm not going to run through the math, because it would take me a 3 or 4 hour webinar, is to tell you that oscillators and MACD do not work. They don't have any predictive power in telling you what the future price movement on your chart is going to do. A MACD crossover, utilizing data from your trading chart, in other words, using price coming off of your chart, has no validity, and neither does an oscillator. And I could have shown you a different group of slides, because if you look at an oscillator, there's people who treat it different ways. Some people look at an oscillator and in an overbought market, say the bulls are in control, and continue to buy the break of every long pivot on an overbought market. And other people, other traders, use an oscillator and wait for divergence, and they look to fade the market against the overbought signal. So you have two groups of traders trading the same indicator in different ways. Now, what we wanted to look at is who's right. I mean, do you use an oscillator to continue to buy? Does it tell you that the bulls are firmly in control when it's in the overbought mode? Does it tell you the sellers are in control when it's oversold and continue to buy down pivots? Or do you feed it? Does it tell you that the sellers are running out of gas when it's oversold? Look for a divergence signal and go counter trend. Or do you look to see if the buyers are running out of gas in an overbought market? Wait for a divergence signal and trade a counter trend. Well, the answer is that everyone's right and everyone's wrong, and that it works sometimes as a divergence signal and works sometimes in continuing to predict that the market's overbought and continue to buy to the upside. The problem is when an indicator works sometimes, it doesn't work other times, its predictive value is zilch, is zero. So there is no predictive power in an oscillator, and that's why we don't use them. And the only person who's ever determined that the oscillator has mathematical predictive value of trading, of predicting future price movement, doesn't exist, because there's no paper ever published on the subject. The same thing with the MACD. If you think a MACD crossover is predictive of future price movement in the direction of the crossover, it's not going to happen. And this is why 95% of day traders go broke. They use these signals, and a lot of them use a combination of an oscillator and a MACD to predict the direction of price movement on their trading chart, and they get slammed because there are multiple false signals. Now the key here, and this is the first indicator that I want to show you that we use, has been proven to us to be a very powerful independent variable. And the first thing about an independent variable is it has to be independent of price movement on your chart. If it depends on how price movement on your chart goes, then it's not independent. I'm not saying this very articulately, but we want indicators that predict price movement independent of price movement on your trading chart. So what background bias on our platform does is it looks at the direction of the market on the two higher time frames. Now, if you're trading a 5 range, which is what this chart is, of crude oil, or you're trading a 5 range of, say, Delta Airlines, or you're trading a 5 range of the pound cross dollar, it automatically defaults to an 8 and a 13 range, which are the two higher fib numbers. And it looks at the direction of the two higher time frames to guide the direction of what's going on your price chart or your trading chart. So this pink background is created by the direction of the two higher time frames. Now we have 3 different down colors and 3 different up colors, and they all have different power. The pink is the most powerful down color and is a very unique independent variable and goes into our equation to determine the direction of price movement on our trading chart, and it's been mathematically verified to increase the precision of your trading. When you have a pink background, it means that the 50 is sloping to the downside on your 8 and 13 range. It means our proprietary 15-period moving average is moving to the downside on our 8 range and our 13 range. Now, if you're trading, say, a 3-minute chart, it's going to default automatically to a 9-minute and then a 27-minute. It goes in multiples of 3. So your 3-minute, 3 times 3 is 9, 9 times 3 is 27. It's going to look at the direction of the 50 simple moving average and the 15 proprietary moving average. And it's also going to assess all downside support. So by not having to look at your two higher time frames and just look at the background, when you have pink, it tells you that you have no support to the downside to break. The 15 and the 50 are moving down on your higher time frames, and price on your higher time frames, as I said, actually, is below both the 50 and the 15. Now, what's going to happen during that period of time on your trading chart? Well, price on your trading chart, the shortest time frame, is almost always going to move in the direction of the two higher time frames. They're going to drag price down with it. So when you see the pink background bias, to the upside, it's dark green. Dark green tells you the 15 and the 50 on your two higher is moving to the upside, sloping to the upside, and you've broken all resistance to the upside. So you're going to increase the positive predictive value of an entry by looking for a signal short. Now, we haven't talked anything about what the signals are. This is solely a bias. And when you see that the bias is pink, you're looking for an optimal entry. And the only entry you want to take is to the short side. That's a true independent variable. And it doesn't matter what the oscillator says. It doesn't matter what the MACD says. This price is going to desperately want to fall to the downside. And it does almost all the time. Now, the next independent variable that we use is called a quant analysis. Now, everybody knows that what changes the direction of a market, and this is bonds. And I wanted to look at different markets. I looked at all futures markets, but there's no difference with stocks, and there's no difference with Forex. Is institutions, for more or less, on any given day, are trading a fixed amount of money. Over time, there's money flow into mutual funds and out of mutual funds. There's money flow into the stock market and out of the stock market. But for every given day, it's reasonable to assume that the big institutions are working with a fixed amount of money. And really, it's not a stylized concept. It really is true. And what they're doing is they're just rotating that money through different sectors. And what they're trying to do is move into the sector that they find to be the most advantageous given external events. So listen, during a period of great indecision, when risk is off and they don't want to be in stocks, they move into the more safer investments. And they roll this money around all day. And you can see that what we did in the quant lines, and the reason we call it the quant, we could call it money flow, but we wanted to give everyone a little bit better feeling of what this does, is that this truly tracks the direction of money. Because in each line are 3 markets that have been quantitatively weighted based on the correlation coefficient with bonds. Now, the market must move in either the same direction as bonds or in the counter-trend direction as bonds 70% of the time or greater to be inserted in the line. And the real magic, or kind of the secret sauce here, is what these 6 markets are. And we're not going to tell you what they are, because it took a long time and an incredible amount of analysis. All 4 tested on 2 years of data, and what we do is we replay it in the office over a 2-year period at 500 speed. At 500 speed, it takes us 3 days to do an analysis of 2 years of data at that speed. But it tells us which markets move up when bonds move up, and which markets move down when bonds move down, i.e., where are the institutions pulling money to move into bonds and its correlative markets, like Treasury notes. Bonds and notes have a high correlation. When bonds go up, notes go up. Other markets go up when bonds go up. Some of the safer investment vehicles go up. And the riskier investment vehicles go down. So this is truly telling you, when we have a confluent sector rotation of major money. Now, the reason, again, these indicators don't rely on price movement on your trading chart. If they do, they become dependent variables. If price goes up, the MACD crosses to the upside, and the oscillator goes up. We're not interested in that. What happens here is this indicator is driven by 6 other markets and has nothing to do with price on your trading chart. And these indicators are telling you that money is flowing into bonds at its correlative markets, because they're all going up, and out of the markets that the institutions are pulling money. Now, these lines only line up when the institutions are at work. It's impossible for commercial traders to manipulate 6 markets in a way that create this kind of confluence. So when you see dual green quants on bonds, you are going to only look for a long trade. Again, both background bias and the quant analysis indicator is only going to give you a bias in terms of direction. We have not yet even got to the trading entry. We've only gotten right now, so far, into the trading direction. But the trading direction is key. When you know with incredible degree of precision and reliability what direction that you want to trade in, 2/3 of the battle is won. Finding a trading entry is actually easier as if you know the direction. Now remember, each of these independent variables have to be met. These are trading criteria. This is not an art, it's a science. And if you treat it as a science, you can't give away, as discretionary traders, we can't give away any of these independent variables. Should we take a trade when the quant lines are yellow? We shouldn't, because we don't have a bias in terms of direction. Money is flowing in some of the correlative markets, out of the other correlative markets. You know what this is known as? Chop. And you can see it's not an accident that bonds here are just moving randomly. Should we take a trade when there's one yellow and one green? We shouldn't, because look at and price is choppy because we don't have both quant lines green. We have 3 correlative markets that are moving in potentially opposite directions, and we don't have an alignment. Money flow is not being driven by the institutions, and we stay away from our trading chart. Oscillator and MACD and Fibonacci as well are irrelevant in this equation. Now, here's the other thing I was talking about. A lot of people are price action traders, and price action is very important to defining a trading entry. But we want to always trade with the trend. And the reason we do is because it's the institutions that determine the trend. They're determining the bias is up. The trend here is up. If we try to counter trend against the flow of institutional money, we're going to get hammered. I mean, it may work once on a small retracement, or we may catch a reversal where the institutions give up and stand back. But in general, counter trend traders wind up really losing their shirt. If you take anything away from this lecture, this webinar, that's the one thing I really want you to ingrain in your head. Don't look for a bottom. Do not look for a top. Do not look for a reversal based on any indicator, because you're going to get beaten up. You may get one winner, but then you're going to get 2 losers. And day trading is all about the number of winners, a number of losers, not the number of winners. Now let's take a look. Here we have a market, and I purposely removed it because this could be what this market is. And I purposely removed this candle. It could be a 13 range, a 35 range, a 55 range. It could be a 3-minute, a 9-minute, a 27-minute. These could be daily bars, 4-hour bars. It's irrelevant. We know that the 50-period simple moving average, the 50, is moving to the downside. We color it, and we optimize the slope. When the slope is yellow, you can trade. When the slope is green, you cannot take a short trade. Remember, it's an important independent variable in our equation. We need the 50 red, and of ultra importance is we need this modified 15 red. This is really not just a moving average. It's a compendium of 2 moving average, of 2 indicators. And if you put, this is really not the EMA, this is a misprint. If you actually put the 15 period exponential over it, it's going to crisscross it wildly. If you put the 15-period simple over it and the EMA, they're all going to go wild. This is built for stability. And when we go to the charts, I'm going to tell you what it's built for. Now, what happens? This is what causes the death of traders in the futures market, traders in the Forex and stock market, and it's the ultra death of options traders. They take a trade in a financial instrument that's in a defined downtrend, but it moves into consolidation, and it starts to move sideways. Now, depending on your time frame, consolidation can last minutes, it can last hours, it can last days, or it can last weeks. Now, if we're trading a short time frame on futures, stocks, or Forex, it doesn't hurt us. But if we're trading options and we buy them, the price of our option wanes, the financial instrument that was in a downtrend hasn't moved, and we wound up losing all our money. So what we do is we trade out of consolidation, and we look for consolidation to be a great entry signal. And that's one of the things that the software will signal to you. Now, I want to show you what's going on during consolidation. Here, now, we have defined consolidation optimally, and I'll show you on our trading chart, which is why I have as few slides as possible, because I want to give you, I don't want, again, give you stylized, I want to show you our methodology and have you understand where we're coming from. But the nuts and bolts of this come right off our trading chart, and I'm going to show you how we traded today. Now, we have traders trapped short. Anytime a candle closes to the downside, there's a predominance of short traders. Now, we have order flow as a separate independent variable. I just didn't want to cloud this up with too many independent variables. But order flow is important, and you'll see how it's projected on our chart. Now we have a group of traders trapped to the long side. Here we have a group of traders trapped to the short, trapped to the long, trapped to the short. Now, all the traders trapped to the long side are trapped in the counter trend direction. And from now till the end of time, we're going to have the small commercial trader who decides he's calling a bottom here, counter trend trade. And they're going to get run over almost every time because the institutional money is creating the downtrend. So we look for a signal right off resistance, and consolidation almost always breaks out in the direction of the trend. Now, that's a signal that we leverage on the transition zone trade. We look to trade out of a retracement or trade out of consolidation in the direction of the trend. And we look to do it optimally right at the time when the institutional money really kicks in to power the market strong in the direction that we want to. So we can just not get 10 or 15 ticks. We can get 25, 30, 40, or even 50 ticks. I'm going to show that to you. And if you look at this move here, we don't know if this is a transition zone because we don't have bias and we don't have the quant lines. But if you're in here and you take, I didn't even take how far this trade went down, but this is a huge move to the downside. And what powers it down is not only the addition of additional sellers, but stopping out all these unfortunate buyers. And the longer the period of consolidation, the more buyers you trapped and stop out, and the trade is fired down as all these traders get stopped out. Now, I'm going to show you the actual, I'm going to move to the charts now. I'm going to show you the trade before we start looking at entry criteria and targets. So let me click out of the slides. Let me exit them if I can. Okay, we have. Now, these are our charts. Now, you can see that, and if I go to the account, I can't for some reason. We made really nice money today. I'm going to right here is an entry. It's not, and it's a transition zone trade. It's not a transition zone. It's the wrong color. But if you look here, the reason you would take this trade long, on the E-mini, we have 9 correlative markets. 9. And they are telling you that money is flowing strongly into the E-mini. Now remember, the color, what's important for you to remember is the color, unlike all the other lines you see on all the other trading charts, the lines are in green because the market goes up. The market is going up because the lines are green. And the cause and effect is what makes this an independent variable. If the market rising turned these 3 lines green, that's a dependent, useless indicator. And that's what happens with the oscillator and the MACD. The market rises. For another reason, the oscillator goes up, MACD crosses to the upside, and you've got your long entry, and sometimes it continues, and sometimes it reverses and stops you out. Now, as long as money is flowing into the market is going to continue to rise when you catch it early. And what this is telling you, and this isn't the transition zone, but it's a form of it, but it's not one the algorithmic automatic system takes, is this lighter blue is telling you that there is an alignment of the higher time frames to the upside, not the strongest alignment. That doesn't occur till here. But here's a trade we can take on the platform on a discretionary basis, and it's right off support. The 50 is green, the 15 is green, and what we get if we wait is a potential move of 5 3/4 points. Now this isn't a blue line. I don't know what that is there. There's the candle. That's the leverage of the institutional direction, and you see the candle surrounded in blue? That tells you that order flow is to the upside. There's an excess of buyers, not on your trading chart, on your 2 higher time frames compared with the previous candle. And this is a C candle. It engulfs the previous counter trend B, runs these counter trend sellers over, and gets pushed up by a whole bunch of forces. Now I'm going into really some of the methodology that really isn't part of the transition zone trade. And some of these indicators are not included in the transition zone software because that one trade configuration is what we're looking at. But I'm going to show you the whole platform. I didn't want to, normally what I do is I just project the transition zone software. I'm going to project the whole platform. Now let's take a look at crude. And in fact, I'll just show you quickly our trades today. They're on the chart. Where are they here? This is today. Hold on a second. Oh, you know what? In order to do that, you have to give me 1 second. I'm sorry. And I usually don't do this, but I have to connect the data feed. So give me 1 second. Let this connect, because I really want to give you a really, really good grasp of what we're doing. It's going to come up in 1 second here. It's connecting. Here we go. This is how much money we made today in the trading room, trading a very tiny number of contracts. I only traded with 2 contracts a trade today, and we traded a total of only 8 contracts. If we would have traded 4 contracts on crude, we would have made closer to $800 or $900. But we're up well over 1,000 for the week. And what we're doing is we're looking to hit singles and doubles with low risk to the people who trade with us. We don't like to take drawdowns big drawdown, so I keep the risk small. But making close to $400 on 2 contracts isn't easy. But I'll show you how we trade. Now, we didn't get a transition zone today, but I'm going to show you a lot of transition zone trades. I just have to wait for the charts to reload. And I'm really going beyond the scope of our discussion, but I want you to see everything. And I don't want to confuse you by throwing our whole methodology at you, but because we're going to focus in a second on the transition zone trade. But I want to show you how watching independent variables is really the key, and not watching these ridiculous dependent variables that everyone's been doing for half a century and getting their accounts crushed repeatedly. Now, let's just take a look at the E-mini. Here's the entry signal. This is a signal. I'm just looking at this right now. I haven't seen it. Out of consolidation. Remember I told you we had a consolidation indicator? There's the triangle. It's a system-generated signal, and this is not transition zone, but the software tells us that there's a period of sideways movement. And for us to read it, it's very difficult, but the software reads it. Now, it's up to you to decide whether you want to take it. You've got 2 quant lines in your direction. That's 6 markets. You don't have the bottom. So 3 markets, but none of the markets are moving against you. And what you get, if you take it, and I would take this trade, is a tremendous winner right off the consolidation signal. 9 points. Now, I mean, how many platforms can tell you to enter a 9-point trade on the E-mini? We can, because we leverage all these independent variables. Now, let's go, and I'll show you our trades from today. Here they are. Now, the first trade, you really have to become experienced. The #1 quant line, and I'm going to go through this, and this, I'm not even going to mention the transition zone. All I'm going to do is talk about our entries today just to show you how powerful it is. It's the major quant. This has the major correlative markets. If I have my #1 quant with me, and I have background bias, and you notice this is taken off a dual support. This is market profile. This is the value area high, and it's a proprietary 15. We get a break. We get a retracement. The candle surrounded in green that tells us order flow is with us to the upside on our higher time frames. We went up for 2.25, for 2.25 points. Our actual profit on the trade was $112.50 on 2 contracts. Now, here's the only counter trend trade we take. It's a very specific setup. It went 21 ticks, 5.25 points. It's the only time we trade against the trend. And there's a unique reason why, and I'm not going to go into it because this is really an expansive discussion of our whole trading methodology. But what I did was I took the trade-off at support of the point of control. So the trade came down, hit the point of control, and I don't, because I'm a very conservative trader, I don't assume it's going to break it. So we made a measly $50 on a 21-tick trade. Now, I could sit up here and tell you and lie to you and tell you, well, you know, we made hundreds of dollars on this. But remember, if you're a conservative trader, you're going to assume that the point of control has a big potential to give you a bounce. So I closed the trade. We made 50, and I took that right off of our control panel. And that's what we do at the end of the trading session. I go right to here, and I'll show it to you. And I want you to see with the kind of transparency we trade with, and then we're going to go into the transition zone. What we do at the end of the trading session is we go here, and we go to our trades. And I had one for 112, one for 50, one for 90, and one for 112.50. This $50 trade was the ES trade And that's why I put the amount of money on it. That's what everybody made who was in that trade, pretty much. Then our next trade on the E-mini was a traditional trend trade. I wait for everything to align, and here it is. Was the move up, the retracement. You know, I had a little concern about the value area high, but the candle was halfway through it. And in this case, I had my best background bias, and I had triple quants. And it went up 7 ticks, and we made 112.50 on the trade. And the third trade, I'll show it to you, was on the E-mini. I was on crude and was right here. On 2 contracts, I took a move up, a pullback to the support of the value area high, order flow and momentum. This is a transition zone, but it's not an algorithmic entry. It's not going to get us in. And it went up 11 ticks. And what we made on 2 contracts is $90. So I traded 4 like I should have. This would have locked in about 200, a minimum of 250 based on our ATM. We take 2 contracts out at 10, that's $200. 1 out at 5, that's $250, and we wouldn't have made much on the runner. So, but we would have made 5, so we would have made $300. I was just very conservative today. So all we did was trade 8 contracts on 4 trades. So 6 of those were on the E-mini, which is $4 a contract. 6 of them, which is $32, and 2 of them were on crude. So we had very, very little commissions, and we cleared a nice amount of profit. Now let me show you the transition zone trade. Hold on one second. I want to do it on crude, and let me just go back 10 days. Let me go back 20 days. Normally I just go back 10. And I'm going to show you some really amazing setups. Because I'm going to show you what this leverages. Now, Tuesday, Wednesday, and Thursday, I have about 12 or 13 trades. I have only 1 loser in 3 days. Monday, a little bit of trouble, but I made money. I'm going to take off the drawing objects because I teach a didactic session in the afternoon, and these trades this are littered with all kinds of lines and boxes. And now, the transition zone system can be taken in one of 2 ways. It can be taken on if you get the transition zone software, as a part of the webinar special, you're going to get 6 months in the trading room. The trading room is $299 a month. So it's a tremendous deal. But we wanted to give it to you because I want to hook you on our system. It's kind of like I want to plug the heroin into you so that when that 6 months is up, you're a customer of ours for life. Now, it will not trade into an area support to the downside or resistance to the upside. So I want to give you an honest signal. And as only one other thing I want to mention is the fact that fractal indicators, when you close the platform and reopen them, NinjaScript creates a problem. And here's the problem. When you're trading live, a fractal indicator is analyzed this way by the platform. It looks at the candle that's forming with the candle that has just formed previously. When you open it, it then compares the candle that's formed to the candle in front. So it pushes everything back. Whoops. 1 candle. So it's going to push the change of the quant line back a candle and the transition zone back a candle. And that's just the way NinjaScript is. Now I want to find you an honest algorithmic electronic entry and show you everything that the system looks at. And here's one right here. Now, this is an algorithmic entry. And let me tell you what the system looks for. It looks for, you're going to see on my charts, a dark black line created on this candle. Because there's the transition. We go from any other color to dark pink. And we know that market bias is strongly to the downside. It also shows you that the quant line, in its analysis of correlative markets, is pulling money out of crude. And the propensity for crude to fall is enormous. Now, the black line that forms isn't an indicator. People are calling me all the time and they're saying, I don't get that black line on my chart. And the reason is it's not an indicator. It only appears on my chart and it doesn't trace and stay because it's not an indicator. It just shows you that the algorithmic system has switched on. And if you're trading it the automatic platform, it's going to look for an entry for you, and it's going to take the first retracement after the zone, as long as there's enough room to the downside to get your first target. If this pivot was into the trade, the algorithmic system wouldn't fire. Now, we could potentially take it as a discretionary trade in the room, but we're going to pretty much stick with the algorithmic system, because the automated system, because it's so good. Now, this is a long way off of resistance. It's 6 ticks. Now, in the room, we like to trade 3 to 4 ticks off of resistance to the downside, off of support to the upside. But the algorithmic system on a transition zone gives the trade more leeway. So it would have entered here, and it did. The problem was this was before the room opened and before we turned the system on. And this move went 34 ticks. Now, based on the ATM we have, the trade would have closed automatically at the pivot. Remember, the system always makes the assumption that the trade is going to close at an area of support. So the trade is actually going to go, the entry is 1 tick below the close of the candle, and this is a real trade. It's going to hit the pivot at 28 and close. You're going to make $280 on your running contract, and your first target is 7. So you're going to make a total of 35 ticks or $350 on this transition zone. Now, I'll go over the ATM with you. We trade with 2 contracts. So your risk is going to be small. But here's what makes the risk smaller. Let's say that the first candle, and very few of these are losers, less than 5 in 100 of these entries, maximum 10 out of 100 are going to lose, because look at all you have going for you. No downside support. Order flow is with you on the 2 higher time frames. Trend is with you on the 2 higher time frames. Your trading chart is perfect. You're trading right, and here's the thing about the trade. Here's where we believe the institutional money starts. Right here. When all 3 markets are moving in the same direction, that has to be the commencement of institutional money. Let me tell you why. And I don't want to get esoteric, but it's really, this is the way you have to look at it. And I'm going to show you multiple trades like this. But let me just show you quickly. The system automatically is going to close on an up candle. So let's say this goes 3 or 4 in your direction and then reverses. And this is one of the unusual losers. You're going to close on an up candle. So even though your stop is 10 ticks initially, you're going to get out of this trade with a stop of only 5 or 6 ticks. So your average risk assessment that we did on 2 years is your average loss is $110. Your average winner is closer to $300. And that's based on 2 years of market replay data. So at 2 contracts, first target is 7 ticks. At 7 ticks, the stop goes from -10 to -5. You're still at risk for $20. You've made 7 in your pocket, but you're still at risk. Actually, first target, you've locked in $20. So if you lose the trade, you make your commissions, and you have enough to go to McDonald's and buy a Big Mac. Almost all these trades go 7. Now the second target is the runner, and there is no target. Because what we want to do is we want to capture as much of the trade as we can. It's on a 15-tick trailer. It's a big trailer. And once we get to 10, it starts to trail. At 10, that -5 starts to get dragged with the trade. Now, the exit is either on a pullback all the way 15 ticks, or it stops at an area of support to the downside or resistance to the upside, or if the modified 15 goes from red to yellow. That tells us that the trend is over. That's only on a statistical basis. Occasionally the trend will continue, but that's what we play. We don't, this isn't a roulette wheel. We know when the modified 15 goes to yellow, we're most likely in a trend, the end of a trend. You see it goes yellow right here. It would take the trade out on an up close on this candle, on this yellow modified 15. It wouldn't go, you wouldn't lose 15 because the modified 15 goes yellow. That's the parameters for the exit of this trade. Those are the parameters for the entry. And I want to show you a couple more, and then I'm going to just show you the principle behind them. And I'm only going to show you the real ones. Now, I know that was right. Here's another one. Now, this one on the right edge is perfect. See the vet. Now, here, what you have to do is you have to drag the quant line over, because remember, when you close an open Ninja Trader, it pushes everything one candle to the right. If you move the quant line one candle to the left, you get an entry here. And you don't go very far. But you get your 7, and you make $20. There's the key. Now, here's your transition zone right here. Now, this is at 18:18 at night. I'm not going to look at anything in the middle of the night on 12, when it's trading 3 contracts, because it really isn't fair to the system. Now, here, I remember trading this in the room. This algorithmic was censored by this pivot. We took it in the room, and we took a loss here, and I stayed with the trade. I traded into a pivot. Then I stayed with it, and we had this winner. We had this huge winner. But that's the problem with trading into a pivot. They don't always break. Let me see here. That's 5 o'clock in the morning. Now let me check the time here. Now this is no transition zone here. It's too far off. This is too far into the zone. You've got to get the retracement within 5 to 7 candles max after the zone hits. Now here's the most powerful transition zone entry. It's when the transition zone is created on the pullback candle right here. And this is 10:30 in the morning. This is going to get yanked over, as is the zone. It's really going to be 1 candle over. This isn't going to be a staggering winner. But the point is, you make money on the trade. It takes it right out here at support. You make $200, 13 on the runner, 7 on your first contract. And the algorithm is going to take the trade out at 20 ticks. Now here, let's be in all fairness, let me see if this is going to, see, it's going to censor the trade because it's trading right into the value area low. And what happens is you get a bounce off of it. I'm showing you the live trades. You have to have a red modified 15, and I can tell you that was a trade, but it's not. Now this is crude inventory report. Oh, there's no retracement, so we have no entry. Here's your perfect trade. There is the transition zone. There is your quant line. It's 11:30 in the morning, 11:32. Now, when you see multi-time frame alignment, and you see the correlative markets, and you see the candle has order flow, so the candle's blue, order flow is aligned to the upside. Here's where you get your monster winners. And this is an algorithmic entry. I've already posted it. And this trade goes 41 ticks. Now, on this trade, you're going to actually lose this trade on this pivot. It's going to take it out. And in fact, on the right edge, it's going to take it out at the value area high. I don't want to tell you the trade's going to trade through it. It's not going to. It saves you a million losers. So you're going to get on this trade. $20 on the runner, 7 on your first contract, 27 ticks, $270. And that isn't bad. And here's your next algorithmic entry. That's a perfect algorithmic entry right here. Now, remember, when you hit +7, you move to -5 and you lose it on the wick. So this is a McDonald's hamburger trade. You make 20 bucks. That's all. Because you got a second retracement and then a big move down. And the system will not take a second retracement. We will in the trading room, but we won't take this on the algorithmic transition zone. And I'm only giving you real trades. I'm not giving you the garbage. Because if you get the system, I don't want you to have unrealistic expectations. I want you to see what you're going to get. And here is your stellar entry. First retracement in the trend. Here's the zone. Count the candles. It's 1, 2, 3. It's only 4 candles in. And the entry is enough through the value area low. And the right edge tells you to give you an entry to the downside. And look how far you go. Now remember, it has to come back 15 to stop you out. This comes back 14. And that's why I've looked at this trade board. That's why we set the trailing stop at 15. What we saw on multiple transition zone trades was the fact that it came back 14 but not 15. Now on the right edge, the value area low moves. We have a very, very different kind of market profile. So as you scroll across, remember the entry had it up here and we're below it for the entire trade. So you're going to get this entire move to the downside. Nothing here well, you're going to get stopped out right here on this down close because the modified 15 turns yellow. And that's going to take you out at 32 ticks. And you're going to make 39 ticks on this, $390. Now, again, the modified 15 tells you the trend is over. And for a while, it does drop sideways. But then it starts down again. And you're just not going to capture that. We can't trade it in the room. There's no entry. And the algorithmic transition is not going to trade this again. Remember, we don't take the This is a second retracement, third retracement, fourth retracement, there's no entry. But $390 on 2 contracts on 1 trade is not half bad, it's great. And I'm telling you, I can do this all day. The point is, I'm just giving you the real entries. And the second point is, it's super hard to find a loss unless you trade at, at 1 o'clock in the morning when crude is crossing 10 contracts a minute. And if 8 people are trading crude, you don't want to be in the trade. Problem with this is there's too much upside resistance, and you're not going to get the trade. And here is your stellar trade, right here. I remember this trade. Remember, this is going to come 1 candle over. So the quant line is going to be here. Now the problem with this trade, I see it now, is the 50 is red. Will not take this trade on a red 50. 50 has to be green. And I'm not going to show you trades that aren't the real thing. And this comes up without, and this is way too far in the zone to give you a transition zone. The trade is too mature. And here's your entry right here. The retracement is on the zone. Your entry is 1 tick above. The trade's going to take it out at upside resistance. You get 8 and 7, $150. Now all you do is bank money. Here is your retracement. On a green modified 15, a green 50, the zone is only 3 candles long. Quant line is green. It's 9:38 in the morning. You've got real nice volume. Now let's see from here to here if this takes you out. Comes back 12. So you are not out of the trade. So you're in here, and the trade goes up here. There's no reason to close it here. It goes 41, but you're going to give back 15 ticks on the trailer. So you're going to get 26, and you're going to get 7. So 26 to 7 is 33. $330 on 2 lousy contracts is a lot of money. That's a whole day's worth of trading. And I listened to a video today of a lady called Day Trader Chick, and she has a trading methodology, and she was talking about how it takes a couple of years to make $300 a day trading stocks. Here's another trade. Move the transition. Now, this is coming in the middle of the night. It's really unfair. Actually, it's not. It's coming at 14:01. It's probably a time we're not going to trade, but it shows you the setup, and you can see what a huge move to the downside is. Now, I'm telling you, I've looked and looked and looked, and I cannot. It's very, very hard to find a loser, and that's the key. It's about taking your equity curve and just driving it to the upside. Now, some weeks we're going to get more. Okay, I hope my sound is back. Okay, good. What I was saying was the key here is that it gets you into multiple winners, keeps you out of the losers, because the entry criteria is so stringent. It has to meet all the entry criteria. And I just want to review this. I don't want to bore you, and I know I'm running a little bit over, but I want, even if you don't buy this system, I want you to understand something. You can trade with sensitivity. I'm going to do this really quickly. Or you can trade with specificity. These are mathematical terms that people don't ever talk about, but these are the linchpins of day trading success. If you trade with specificity, you're looking for all the true positives. And what are the true positives? Every single move that's going to get you to your first target. If you do, and you give the market a lot of leeway, you don't make the market come to you. You just can't tolerate a move that will get you to your first target and you're not in it. But if you trade with sensitivity, I'm just going to reverse these two things. What you're going to suck in, and it's a mathematical axiom that this is going to happen to you. You're going to trade in a lot of false positives, and that's what kills all the day traders. It's the losers. So you're going to get true positives, but you're going to get a lot of false positives. Your trading methodology must be based on trading with specificity. What you're looking for are the true negatives, all the moves that are likely to fail. You're not looking for the moves that are likely to succeed. You're looking for the moves that are likely to not succeed. And why are they not likely to succeed? Because they don't meet your entry criteria. And if you're looking for all the true negatives, you will sometimes get false negatives. And what's a false negative? It's a trade that goes 35 or 40 ticks, didn't meet your entry criteria, and you're not in it. But you can't cry over that trade. If it doesn't meet your entry criteria, you're also eliminating tons of false positives. You want to trade with a tremendous amount of specificity. I don't care what system you use. Stay and look for the potential losers. Secondarily are the potential winners. If you do, your positive predictive value of a trading entry or your win percentage, put easily, is going to be high. And that's what you need. You don't need a lot of winners. You need to eliminate the losers. And that's trading with specificity. Now, I just want to tell you one more thing, and this goes right back to the transition zone trade. The positive predictive value of a trade is sensitivity over specificity times prevalence. Prevalence is an incredibly important number. Prevalence. Now, what is prevalence? Prevalence is that period of time when the likelihood of getting a winner is highest. And when are you most likely to get a winner? When the market is trending. That's when the prevalence of a winner is high. And now the sensitivity and specificity of a trading entry are fixed numbers and inherent in the independent variables in the equation. What changes is the prevalence, and that's what you control. You control the prevalence. If you only take an entry during a trend, you're optimizing the prevalence of a win and thereby optimizing the positive predictive value of your trading entry. That's what we do with the transition zone. And let me just say a couple of more things without driving you crazy or boring you. It's a little bit abstract, but it really, really is important to understand. Every single closed system has a tendency to go to maximum randomness. That is a law of thermodynamics, the first law, in fact. If you have kids and you look at their room, it just becomes a mess. The only way that you can create order from disorder. Now remember, if you don't apply something to the market as a closed system, it's going to go into chop. And why does it go into chop? I've always asked myself, who trades chop? When there's no direction, who the heck is buying these contracts long and short and long and short? And why is the market, what is chop? Well, chop is simply a mathematical necessity, because without the application of something important, the market as a closed system is going to become random. That's why the prevalence of a successful entry drops when the market is chopping and your software doesn't clearly define a multi-time frame trend. And what is that application? In most closed systems, it's energy. In the market, it's the application of money. And when institutions move in, they create order from chaos. And that's what the system tells you. When the quant line, that's why the quant line, which is an independent variable and totally independent of background bias, they correlate so highly, because with the application of institutional money to rotate the correlative markets in the direction you need, and the multi-time frame allowers. Now, they don't always do, you see here, the institutions are still applying money based on our analysis, and the market goes into a period of chop. But you see the directional bias is still to the downside. That's why, even with everything, you got to look for a good entry. But we know our bias is to the downside. But you're not going to get this multi-time frame downtrend until you see the application of money creating order from disorder. And what we want to get is a retracement, a very conservative entry at the start of the institutional money flow. That's where the institutions really begin the powerhouse move in the direction they want to move the market. Now, sometimes we don't get an optimal entry, like here. But then we can take a discretionary trade. We don't get a transition zone, but we know the direction we need an entry, and it's to the short side. We're never going to trade against that direction. So that's really the be-all and end-all of it. You can take the system in one of two forms. You're going to get a transition zone entry. We're going to call it in the trading room. If you buy the system, you're in the room. If you don't want to deal with the trading room and you don't care, you don't even have to watch it if you're on the automated signal. And it's going to get you in the trade, manage the trade based on the specifics that I told you. And I'm going to put the slides up really quickly, and we're coming to the end. And let me just scroll down. Right here. Here's the entry criteria: early retracement after the background turns, entry on the first retracement, first target 7 ticks, stop it's 10. When it gets to 10, it goes to -5. First target's hit, you're still at risk. It goes to 10. You go to -5, and then you've locked in profit. And we're looking for 20, 30, 40, 50 tick moves. The exit criteria: 15 tick trailing stop is hit, upside downside resistance or support is hit, modified 15 turns yellow, you're out of the trade. Now, you can always close it discretionarily. I mean, if you're at +25, +30, +40, and remember, you got to go 15 more in order to make more money because you're on a 15-tick trailer. And if you're at +40 and you got $470 on 2 contracts and you want out, just close the trade. It's $470 on 2 contracts, and you're done for the day. So you always have that option. You can always intervene, even if you're on the automatic system. Now, here's your perfect trade. And I just pulled it to just show you, and this was on crude on 8/12. Here's the retracement right at the commencement of the zone. It doesn't come back 15. This candle's a 14-tick retracement. It goes 61 ticks. Now, it's going to take you out on a 15-tick trailer. You're going to make on this trade. I didn't even put the amount up. But that 61 minus 15 is what 46? That's 467. Is $530, I think. Don't get my math there, but if you can get $500 on 2 contracts on 1 trade, I mean, come on, But the issue is, it's not getting a big winner. It's never getting a loser. There is the key to the beauty of the trade. If you get a 61-tick move, but then you get pulled into multiple losers, the signal is useless. because at the end of the day, you're going to lose money. What makes it so valuable is that you're going to see a loser very, very, very rarely. And the loser is going to be on a down close formation that's going to take you out on average at $110. And the losers are so rare that one winner will blow that away. Now, for the webinar special, we're giving it this is the discretionary entry, $798 for the transition zone software. It's normally, we're putting it up on the website at $14.99. The transition zone software, where the whole trade is managed algorithmically, is $3,400. We're giving it for $16.99. This is lifetime. And everyone who purchases, I'm going to give another webinar if there's so anyone who has questions has the ability to ask, because I'm going to look at the questions as I go through the trades. So it's going to be an exchange of information, and everybody will get to listen to everybody else's question, because oftentimes if one person has a question, there are all the other people who have it too. And the first 5 who purchase, you get 6 months in the training room. Now, 6 months of our NDT execution platform, which is really valuable. I didn't even show it, and I'm not going to go into it. It's too much. You get, I give a weekly didactic session where I just go over our whole trading methodology, not just the NDT, but a lot of the information you got today. I'm going to teach you how to trade price action with market structure. The two combined, it's really the science of day trading. And what we're going to conclude is, when this webinar is over, and I'm telling you this is the last transition zone webinar I'm giving, and I mean that, you're going to get all markets. Right now we're only active on crude. On Monday, we go active on the E-mini. We have no second target. Our first target, I forgot. I already talked it over with Leo. We're going to send out, I swear to you, I don't remember. I don't want to tell you. I think it's 5 or 6. It's 5 or 6 ticks, so it's a 1.5. There's no second target. We're taking a big trailer and we're looking to get 4, 5, and 6 points on the E-mini. Then we're going to go to gold, and then we're going to go to the NASDAQ, and we're going to add these markets on. So you're going to get all these additional markets, and this is good through Friday. It's I'm not I'm a trader. I'm not in advertising, but I think it's a really, really good deal. It's very, very fairly priced, and the special is really good because you get all the markets, and you're going to get multiple transition zone trades. The markets are especially beneficial on the algorithmic system because you don't have to watch them. When gold hits and the NQ hits, and eventually we're going to go to more markets. We're going to go to the Dow. You're going to get these transition zone trades very conservative, and they're going to hit for you without watching these markets. Now, here we are at RightLineTrading.com, www. We don't even have the transition zone software on the website yet. We're putting it up tomorrow. And our email's at info@RightLineTrading.com, and here's our phone number. And this is all on the website. You can send us an email. You can give us a call. Rory's here. We make him stay here 100 hours a week. 855-765-6681. And unlike a lot of systems that you're going to see that people sell you, I trade the system every morning in the room. And we are here all the time. So it's not like we're throwing you a piece of software and we don't trade it and then we hide from it. We really work it carefully. Now, we have 3 trades if you're looking at the track record. We have 1 for 41 ticks, we have 1 for 16 ticks, and we have 1 for, where was it? I forgot the other one. Now, unfortunately, we had 1 more. And it was a nice one. I just forgot. Leo's got this all. We had 3 trades and 3 winners, and we had 2 really nice big movers. And we haven't started yet a transition zone spreadsheet, but we will on the website, and we'll post the results. But it's a new system. And that's why we're offering it at this discount, because the people who get in early on it, eventually it's just going to go up, and that's going to be the end of it. Now this is kind of I leveraged the transition zone on this trade, but it wouldn't have been an algorithmic entry simply because it's sticking halfway through the value area high. And the transition zone doesn't have the discretion that I do in the trading room. But I love the fact that the zone was created on the entry candle, and that's why I took it. It was our fourth winner of the day. I had 4 trades and 4 winners. And only because I traded a small number of contracts did I only make 365. Like I said, we could have easily made 600 or 700 if I increased the number. And this was a trade. I saw it, but I've said to everyone in the room, we've got 4 trades and 4 winners. We're not putting any of our money at risk. We're going to stay out. I didn't want to take it. It went 2 3/4 points. Again, the major quant and the intermediate quant are the first and third. The minor quant is the middle. This is all stuff that I will teach you in the didactic sessions. These are the 6 major markets. We don't need that middle quant necessarily, as long as it's not against us. This is a strong background bias. It doesn't indicate what the green does, but it tells you the markets are heading up strong, and you can see we got a 2.75 point move on the E-mini, but I just didn't want to take a 5th trade. Any great trade can always lose, but we had a very, very small chance of a loser. I just didn't want to leverage our money one more time. So I mean, we're up over $1,000 for the week, and if I can make $200 or $300 tomorrow on a small number of contracts, we're going to clear $1,100 or $1,200, which is my goal every single week in the room. If we get a couple of transition zones, we'll do it on 2 contracts, on 2 trades. We just haven't gotten one this week. And here's the thing, and then I'm going to end, and I'm going to look at questions. People complain that they don't get a transition zone. But the issue is when the market does not set up, you're not going to get a trade. And when you don't get a trade, be happy, because the market is not pulling you into losers. That's the key. This week, we didn't have much of a trending market, and when we did, we just didn't get market structure set up appropriately to get an algorithmic entry. Something always foiled the trade. It was either always trading into a pivot or always trading into market profile. We never had a clear-cut trade. And if you look at this one right here, this is too far into the zone to take a trade. I mean, the algorithmic system didn't fire. And the algorithmic system is really good at making an assessment of the trade. It's very, very good. And it won't trade right at the pit open either. When the crude pit opens, the market moves erratically. It will not trade during crude inventory. And I'm telling you, we got 3 winners and no losers. But it's going to take losers. The key is 85 to 90% of your entries are going to be really nice winners. Now let's look at questions really quick. They're not that many, so it's good. You're right, Jack. Jack says that the major reason for this 90% of the mentoring in trading is junk, being peddled in order to make a profit. And you're right, Jack. And what we do is we mentor off the system. I mean, we teach our trading methodology. That's our mentoring, and we don't peddle it. Listen. I believe that if we teach you if you learn what we teach you, it isn't even going to matter if you trade our system. Price action is great, but I'm telling you, I have studied it for years, and trading price action alone is not enough. You need to add market structure. And the structure is the 15 and the 50 creates structure. Price to action traders don't have it. There's no bias. You can take a short trade, a long trade, it doesn't matter. There is no direction to price action traders. Like this trade right here, a C candle to the upside, which worked, even though it's a counter trend, it's just as good as a C candle in the trend. But we know that these trades are have a much higher likelihood of losing. And I've looked at these till I'm blue in the face. You can get a great counter trend winner based on just trading price action, but the predictive value isn't high enough to make you money. I mean, this is a nice counter trend trade. It's 4.5 points. But if you continue to take this signal, you're going to wind up losing all your money. You shall, I did. We've only had 3 algorithmic entries since I started. And the 3 algorithmic entries are 41, 16, and a third amount. It was 30 some odd ticks. Those are the only 3 entries we've had, and we've only been operational about a week and a half. So we don't have a long track record. What we really have is 2 years of forward testing on the system, and the fact that I can go back 10 days on any market and not be able to find a loser. And the reason is I'm showing you the rationale for the trade. It's not a black box system. It's a system that's leveraging money flow in correlative markets and a correlation of multiple time frames. And that's when you want to take the trade. That's the optimal time. If you get a retracement and a move in the direction of the trend. We don't trade breakouts and we don't chase trades. If the transition zone just moves right up, and a lot of times they do, we can't chase the trade up. Like, look at this transition zone right here. We can't just chase this now. Now, it's not a real transition zone, but money flow is moving. It's just the indicators aren't fast enough. Remember, this is assessing the direction of the correlative markets. They're swinging around, but they're not swinging around fast enough to turn them red yet. The point is, this is what causes the death of options traders, the death of Forex traders, and the death of everyone, is that any move to the downside can go and retrace back and then continue, stopping you out, or can go into a period of consolidation. And if you're on a 10-tick stop, that consolidation can be 11 ticks and stop you out and then head down. This is what we teach in our webinars, in our didactic sessions. So you want to trade out of a retracement and out of consolidation. You don't just chase a trade. If you do, you're going to wind up losing your money. You're going to get a trade that goes against you on a 10-tick. It's going to go against you 11 or 12, and then continue down 35 ticks. You're going to get a full loser and have to chase it down a second time. And that is, again, a zero-sum game. This is what I'd say. This is what I'm saying about trading with specificity. We don't get an entry. We let the move go. And you know what? We don't care. We didn't get our entry criteria. It didn't meet it. Forget about it. Forget about it. As they say in Goodfellas, when we do get a nice entry to the downside, right, this is in a transition zone, but it's a trade I might take on the minor quant and the intermediate quant, with the major quant being neutral. Now, you're not going to get a transition zone algorithmic, but we can take this trade. It's a terrific trade. And we're going to get a nice move because we're taking it out of a retracement. There's our entry. And we know our bias is strongly to the downside. And that's 3.5 points. Well, I wouldn't take this trade. This trade would scare me a little bit. It's a trade out of consolidation. This is our consolidation signal. And you know what? Look how far it went. But the reason I don't like it is because I only have the minor quant, and if we move this over, the major and the intermediate quants are yellow. And that's just the way it is. You know what? You're not going to get an entry all the time, but I'm not going to cry over it. If you want to take a lot of risk on the trade, you can take it out of consolidation, but I don't like to take risk. The system gave you a potential entry. As discretionary traders, we have to make an assessment of our independent variables. This doesn't line up well enough for me to take a trade, and even though it fell an appreciable amount, it doesn't matter. We're not going to get every winner. That's the key to trading with specificity. This one, perfect. We've got a dot. That's called a chase dot. That's an entry, and we can take it to the downside. Let me keep going here. Okay, hey, Robert. Robert's in our room. Well, Vishal, you know what? We've thought about letting it run 24/7, but the problem is I don't want traders to trade anything in the middle of the night when there's just the market is so thinly traded. Now we turn it on we're going to start turning on crude oil at 7:30 in the morning, because you can get high volume moves in crude early. We've been turning it on at about 8:30 in the morning, but we're going to push it back an hour, and then we're going to let crude oil run till about 2 o'clock to 2:30 when the crude pit closes. The E-mini, listen, it's up to you if you want to trade it. We're probably going to, when we initiate it on Monday, we're going to probably let it run all day. It'll run from 9:30. It's going to run earlier than 9. If you want to take a pre-market trade, you can. I don't like to. But if you enable the system, the signals are always there. If you want to take a pre-market algorithmic transition zone entry, just turn your system on. If it meets the algorithmic criteria, you're going to get a trade. It's going to happen whether I'm sitting in front of this computer or not. So you're going to have an opportunity to get algorithmic transition zone entries all day on the E-mini until the pit closes at 2:30. If we leave it open after 4:30 on the ES, some people can't trade because it's after market, and I think your margin goes up. And on crude, it tends to become very choppy, and volume is light. You get big moves, but they're low volume moves. And I just want to tell you one more thing that we've done that creates the only honest volume indicator that there is. This number here is assessing contracts per minute. All the other volume indicators assess contracts per candle. And I hear all these people talking about how their volume indicators are great and all this nonsense. If you create an indicator that has a huge volume move can occur with no candle movement. I mean, I've seen on the E-mini 5,000, 6,000, 7,000 contracts cross a minute, but the candle just doesn't move. So what you're going to get is a huge spike on your candle, the candle volume. But what we have down here, each of these black lines is when the minute volume is above the average minute volume going back 15 minutes. I want to know, because this is the histogram that's created below on your average volume indicator has two independent variables, which is awful. It's the number of candles created per minute and the contracts crossing. Well, I'm sorry, it's not per minute. It's per candle or per formation, because you might not trade candles. Maybe you trade Renko, or maybe you trade open, high, low, close. No, and this is contracts per minute independent of the formation you trade. Now, this is the one that tells you the actual volume environment of the market you're in. This one is only telling you, it's telling you volume, but it's also throwing in how fast the candles are created. And who cares about that? I mean, you can judge volatility on your own. What this indicator is meant to tell you is, are we trading in a high volume environment or a low volume environment? And look at the indicator right now. This is how many contracts are crossing on the E-mini per minute. Every minute it goes to zero. That's what you need when you make a volume assessment, and that's what the algo system looks at to assess volume. It doesn't look at the contracts per candle. It can be very, very misleading if a candle just sits there and accumulates an enormous amount of volume. You get a big histogram bar. But all that's telling you is the bulls and bears are duking it out in that candle, and there's an enormous number of contracts stuffed into it. You want to know a real high volume environment, and that's the indicator. I don't know anybody that has done that, and this is really the only way to assess volume. And this is a really quick indication of institutional participation, because when this thing, on crude especially, it's 150, 200, 300 contracts per minute, all of a sudden it's 2,500, 3,000, 4,000. Immediately you see an institutional participation, and you wait for an alignment and hope you get one and you can get in. True positives is a move that makes you money. A false positive is a trading move that loses money for you. Essentially, you're defining what a true positive is. If your first target and a move that locks in profit for you is 7 ticks, and your target goes 7, that's a true positive move. If your first target is 7 to lock in profit and it goes 6 and comes back and stops you out and you lose money, that's a false positive. Now, your targets should be based on the average true range of the market you're trading. The way that we have defined our ATM strategy is based on the volatility or the average true range of our different markets. That's why our ATM strategy and the range bars that we trade on these markets are different. We trade an 8 range on crude, gold, the NASDAQ, the Dow, but a 5 range on the ES, all Forex markets, on the 6E, on the markets with less volatility. And our ATM strategy is different, but we have them formatted for every instrument. We have them formatted on stocks, and this makes terrific entries on stocks to swing trade or day trade. And also, I just want to throw in again, these signals are independent of time frame. If you trade, say we have a guy actually in the Middle East who trades daily bars. He doesn't get many entries, but when he gets one, they're enormous winners. He just has to wait sometimes a week or 10 days to get an entry, but then he profits greatly. You want to trade a faster chart, though, you're going to get stuck in chop. So we don't recommend that, but you can definitely trade a slower chart, but we have to tell you what the best ATM is. And we have hundreds of templates. We were going to send you the link. You're right, Graham. That's a really good point. Graham says the fact that these correlative markets correlated for the last 2 years doesn't mean that they're going to correlate in the future. And the fact is that we have to continually rerun this data. And he is absolutely correct. We do it about every 3 months because it's such a big job. But now that we have the markets, it takes us 3 days to run each market. So on 9 markets, it's going to take us a month to determine that all 3 of these maintain that 70% or greater correlation. And we're due for that very shortly. We have to make sure that a market that correlates 70% of the time or greater maintains that correlation. And he is absolutely correct. Some of these markets have a 90% correlation, but some are just hanging on that lip of 70%. And we want to make sure they stay, or we boot them out of the quant line. Yes, we do. You can come into our trading room. I'll bring up our website. We always offer a free trial. Here's our website. We're in the process of completely redoing it because it's kind of a mess. But what you got to do, this is a free indicator. If you want our SMA 50, this 50, you can get that for nothing. It's a nice indicator because what this does is assess momentum on your higher time frames. If you open it up, you're going to see that this is the one that you get, the moving average colored. This line slope, which we put at 1 as default, is an actual slope that's really been optimized. And you can see the slope up here in the upper left-hand corner. These are our moving average analytics. And it's a slope that really, when it's red, helps you determine that your higher time frames are also moving to the downside. You'll notice, remember, it's an independent variable. It's turning red and sloping to the downside. It's not an accident that it occurs when your multi-time frame alignment occurs. So it really does help you trade. And we don't take an algorithmic entry without that 50 red. But you can go right here and you can sign up. It's right here for a free trial to the trading room. Not a problem. We'd love to have you aboard. No, Abby, you don't. Remember I told you that I was, no, you don't get all the indicators in the transition zone software. And we're going to send out an email right after the webinar, and it's going to tell you. If you give me 1 second, I'm going to reformat this, and I'm going to put in the transition zone template, and you're going to see that you don't. What you get is what you need to trade the transition zone. If you want the complete indicator suite, it's a little bit more money, but this is the transition zone. Remember, you're not taking ABC entries. You're not taking trades out of consolidation. You're taking the transition zone only. Now, I know it looks a little bit bare compared to the normal, but it's only one trade entry, and here's the entry, and I'm calling them in the room. But here's the entry right here at 10:01 on what day is this? On 8/26. And that's an entry you're going to, so you don't get, now I left out mistakenly here, you do get market profile and you do get the pivots, which I didn't put in here. There's the pivots. And you do get market profile because those are strong areas of support and resistance. So market profile is included, but you don't get, but if you want the full suite with the consolidation, remember what we're looking here for in real time is you're going to get, let me put the vertical line, right here, in real time, you're going to get this line. And it's going to be about this thick. And that's going to tell you, it's actually going to come right here. And it's going to tell you the algorithmic system is now on. And it is searching for an entry. And what it's going to do is you're going to get entered on the first retracement. Automatically, you're in here. I'm going to call the trade in the room as a buy and up close right here, and on this move, you're going to get 58 ticks. If you hold it all the way, you have to subtract 15. You're going to get 43 on the runner and 7. That's a $500 trade at 10/26 on August 26th. So you get less, but it's very inexpensive. Remember, it's only $700, and right, we're giving you 6 months in the room. We're giving you all the markets, and somebody asked if it trades them simultaneously, and the answer is it does. On the algorithmic system, eventually, we're going to be on crude, the mini. We're going to be on gold within the next 10 days. The algorithmic system will do it all for you automatically if you're quick enough. Just because the system is not set up to give you these multiple signals, You're going to be able to get these algorithmics on a discretionary basis. I'm only going to be calling them in two rooms, on two markets, crude and the E-mini, on a discretionary basis. You're going to have to take them up by yourself on gold and the additional markets that we add. But the discretionary system is really inexpensive. It's only $700 some odd. That honestly is really pretty cheap. And we're normally going to sell it for 14, and after the webinar's over, that's going to be for one market, and we're going to charge you per market. So it's less, and I don't want to confuse you. That's the algorithmic system with market profile, which I did. We have moving average analytics, we have the volume indicator, all the things that are important for you to make an assessment of the trade, and the quants. And remember, every market has a different quant line, and I'll just show you quickly. And I really don't want to make this run really over, but here's right now. I have the 6E crude, the ES, the Euro USD, the DAX quant line, gold, heating oil, natural gas, the NASDAQ, silver. These are stocks, the Russell, the USD Canadian, the dollar yen, the Dow, bonds, notes. We've done quants for all of these markets. And let me tell you, it took us months. But each of them is an individual quant line. And if you mix and match, you'll find that they don't work. You know what, Jack? I love the Russell. But the problem with it is it's so low volume that I've taken it out. I mean, when I traded 10 years ago when the Russell was on the CME and not the ICE, and you see you have to reload when the indicator because NinjaTrader assesses your background bias wrong. But right now the Russell's trading 50 or 60,000 contracts, and we get a bunch of people. We're going to get, I mean, every trade you get slippage on the exit, slippage on the entry, exit, slippage on the entry. So it's just become difficult to trade. It sets up great. I love the market, but with the kind of volume that we've got now on the Russell, you could listen. You can trade it on a discretionary basis. We'll give you our Russell quant line. I don't even have it loaded into my computer, but we have one. We have a Russell. We have one on every index equity. The E-mini, the Dow, the NASDAQ, and the Russell. Well, I just don't trade the Russell because of volume. If you want to take a discretionary transition zone or trade the whole system on the Russell, you can. We have 9 correlative markets on the Russell. You're just going to have to, the only hassle you're going to have is with volume. And that's the problem. I want to trade a high volume market that's got decent liquidity. I hate taking slippage on the entry. Take a slippage on the entry, cuts that first target down by a significant percentage, and then we got to move our stop back and we adjust for slippage. If I'm really bold, I don't. But that means a first target now is moved at one tick further out. And it's a tragedy if you go the number of ticks you need and then it reverses on you and you get stopped out at break even and you lose a little bit of money. So that's why I stay away from the thinly traded markets. So listen, that's it. But I love the Russell, though. What can I say? Yes, you're going to get an email that has everything. And you're also going to get an email that shows you exactly the price for each of the different systems, what indicators you get. And listen, if you call us and you opt for all the software, it's going to be more money. But it's totally up to you. I really wasn't here to market the whole system. I was here to teach you the transition zone system, really to profile it, because I think of all the entries, it's the one with the best risk to reward and the best single win percentage. And you can make great money on it when you trade multiple markets, even when it doesn't give you a lot of entries. And remember, the number of entries is irrelevant. It's the number of winners versus the number of losers. If one week you get 2 entries and they both make you money, and another week you get 7 entries and 6 make you money, that's all that matters. It's the same, we have an algorithmic system that trades 6 markets, including these 2. It trades the NASDAQ, it trades bonds, it trades notes, it trades the E-mini, it trades crude, and it trades gold. And we put it up and it's reflected in our ATM right here. It didn't take a trade today. But it's creating a beautifully positive equity curve. And sometimes it'll take 2 trades in a day, and sometimes it'll take 1 trade in a week. It's just the way the market is. The key and what makes the algorithmic for all these markets, which trades every signal, really advantageous is the fact that it tries to screen out the losers, and that's trading with specificity. And that's the math behind it, and that's all that's important. And whether you buy our software or you don't, whether you become a member of our family or you don't, that has to be your trading mantra. I want to trade with specificity. I don't care about sensitivity, and I want to use independent variables to make an assessment of a trade. Not this garbage. And I'm going to put this up, and then I'm going to go because I've been doing this for 2 hours, and and it's you. I just don't want to. Let me put this thing in here. Here's the stochastic. It's going to screw up my chart, but it's going to take a minute to load. I don't see it. I don't see it. I don't know why it didn't go in there. Hold on a minute. Maybe I didn't put it in. Hold on. There it is. All right. I'm putting in the most worthless indicator, the most worthless, sophisticated indicator ever created. And all it does is trace out price action. It doesn't give you any, it doesn't predict the future direction when you're on the right edge. It is completely useless. Look at this crossover to the upside right here. The market's not overbought, and this candle goes nowhere. This to the downside right here, and almost an overbought market on this candle. If you want to counter trend trade, good luck. It just doesn't work. Here's your crossover to the, here's the thing when you assess these going back retrospectively. They always look awesome because the crossover is always terrific. But here's the problem. Here's your entry. Right here. Right at the crossover. And what you have is the market consolidating right here. Now the stochastic continues to fall, but you come within 1 tick, 2 ticks of getting stopped out. What you want to do is you want to trade out of a retracement. And you want to trade, and the only thing that's bringing this down are the quant lines and background bias. If they weren't here, the stochastic wouldn't be chugging to the downside. I mean, this is just following the lead of the indicators that truly define market direction. It's not going to do it for you. It's a dependent variable, and it depends on price on your trading chart. And if price goes down, it's going to go down. If price goes up, it's going to go up. See, and look at this long signal here. Even when it does go up, it's, whoops, wrong one. I mean, if you try to trade this in real time, you're going to get multiple false signals. I mean, it's just tracing out price almost to a T, because it's assessing the high, low, open, close of each candle on your chart. It has no utility. And when I close, I mean, we've looked at it, and you know what we even did? We looked at oscillators on 2 higher time frames and had them trace out on our trading chart, and they still don't work. It doesn't predict future price movement. So listen, that's it. Hopefully you'll see the power of the system. If not, I really do wish everyone, I mean, listen, we're the small commercial guys. We're trying to beat the institutions, and what we really have to do is trade with them. And we have to beat all the other small commercial guys who are creating these really nice counter-trend candles for us to run over. I mean, we have to thank them, unfortunately. We don't want to, but that's who we're beating up. We're not going to overrun the institutions. They create the trend, and they're always going to kill us. We have to trade with them, never against them. And that's what the software allows us to do. It defines the trend, tells us when money is flowing into the correlative markets, creates order from disorder, and gives us a great entry into a multi-time frame trend that has a great probability, a very high probability of following through, not just to our first target, to give us a runner and a winner and a big winner. But listen, you can make money hitting multiple singles and doubles. That's what I did this week. I wasn't able to get a triple or a home run. But we're still going to make our $1,000 after commissions this week, unless I have a stroke or a heart attack tomorrow, and I don't think so. So that's how you trade. That's all you need to do. So we'll send you the email. It'll have everything in it. We're going to have an embedded video that's going to show you the components of the transition zone, and again, it's going to have the cost. And we hope we can welcome you aboard, because I really believe from the bottom of my heart that I can make you money. And we do make our traders money, and that's our goal. That's why I don't sell it to you. I actually trade it as well. And we're all here on the front line. So take care. Have a great afternoon. Thank you so much for giving me your time. And hopefully we'll see you in the trading room, and we can run up some money. So take care. Have a wonderful night. Bye-bye.